Good morning, everyone. I'm going to start with going over the reason I called out the UCHF trade and the AUDJPY trade yesterday. Okay. Then after that, I'm going to dive into the topic of our training today. I have taught this strategy on EuroCHF before in the past, and I've also taught the strategy on AUDJPY in our previous session. So this AGFY is an asymmetrical triangle. When you have price cuts in between a diagonal resistance and a diagonal support, we call it an asymmetrical triangle. This is a very, very powerful price action pattern, which lots of traders use to make money on the financial market. The thing about a symmetrical triangle, ascending and descending triangles is you don't see them that often. Okay. So for example, in a month, you may only see three patterns like this. Just three patterns. And this is one of the reasons why I have multiple currency pairs. Because if I'm only looking at one pair, the probability of me spotting this pattern on that pair is going to be very, very, very low. If I'm looking at multiple pairs, in a month, I can spot up to like 3 or 4 patterns across all these pairs. Right. So once you see a pattern like this, there are two possibilities. The market can either break to the upside or break to the downside. Okay. If the market breaks to the upside and the candle closes above the diagonal resistance, you're going to enter the trade on the retest. So if you look closely here, you will see that the market broke this resistance line here, then closed above. Then I dropped the trade at this point here for the retest. And the market just kept respecting that point. So stop loss 10 pips, CP 40 pips. That's 1:4 to word ratio. And the market has been climbing since then. So this market will keep climbing till it hits this 40 pips TP. It'll keep climbing till it hits this 40 pips TP. This is like the third pattern like this that I've seen this month. The third one. And one of them, we took that one. That one was an SL. One of them, we missed that one. That one was a TP. And this one is going to be a TP. So, now about is you don't really see setups like this. All right. So you add your asymmetrical ascending and descending triangle. Add your asymmetrical ascending and descending triangle and put them in one particular box. You call it your triangle strategies. Triangle strategies. Okay. Then add your asymmetrical ascending, descending, and price trap. Put them in one box and call them market trap strategies. You can just call them price trap strategies. Okay. So that gives you two different ways of trading the markets. The new asymmetric triangle, ascending and descending triangle, you're waiting for the break and retest. But before it does that break and retest, it will be bouncing off, you can take advantage of that and trade like a price trap. Right? The same thing too um with your normal price trap. The same thing too with your normal market and price trap. Right. So that's why I called out the AG. But so why did I call out this Euro I told you something. There's a price market relationship. Okay. When it gets to this particular time, Euro just starts going up. Look at it here. I took this one, I dropped this one on the group chat. All right. On Thursday last week. And I dropped this one also on Friday. This one on Friday. It didn't hit TP2, but I asked us to close at some point because it was getting close to the end of the week, and I didn't want us to hold the trade over the weekend. Okay, I think this one needs to break even or so, thereabouts. On Monday, the market did not gap. So if the market did not gap down, you definitely cannot take the trade. It has to gap down first, then you enter 1 hour after the gap down, all right? Then this one here, I didn't drop this one yesterday. I was meant to drop it, but I didn't drop it yesterday. But you can see it here. It hit TP1, then from TP1 got close to TP2, which is 19 pips. Then from there went to hit break even. Then this particular one is this, and you can see it. So this particular strategy now, I backtested it for the last um 4 months, right? Now we are moving into interpreting backtesting results. This is a continuation of our training yesterday. Can I spell interpreting? Interpreting backtesting results to create trading plan. So the first trading plan I created for this UCHS strategy, I don't have a name for the strategy yet, but I'm going to very soon. I can name the strategy ageless because from what I'm seeing, the strategy has been working since last year. So it looks like something that will just keep working for I don't know. I can actually name it ageless after divine. All right, so I did backtesting for May, June, July, and August. Yeah, I'm still looking at August. I'm trading this August and it's going very well. So what I noticed is that the average accuracy of the strategy, if you're ignoring the break evens, because break evens is not profit, just take it out, is average accuracy is 30%. Let's say 33%. Now, after you're done by testing, you have the maximum the market has moved against you, the maximum the market has moved in your direction. Now, you know that the most important thing is your trading plan. Because your trading plan will determine if you are going to be profitable with the strategy, or if you're going to be non, or if you're not going to be profitable. Some persons use very large stop losses. Some persons are going to use very large, very small stop losses and stuff like that. But you need to understand that you need to get the best risk to reward ratio that would give you the most profits. So if you use a stop loss that is very small, the strategy may not be accurate because your stop loss is very small. Most of your trades are going to hit stop loss. Though your risk to reward is going to be higher, but if most of your trades are actually hitting stop loss and you're having an accuracy of like 10%, you will definitely not be profitable. If your risk to reward ratio is not to 1 is to 20, like me. All right. So you need to, and then if you use a very big stop loss, your risk to reward ratio will be very low, 1 is to 1. And if your risk to reward ratio is 1 is to 1, so you will not also be profitable if you're not having an accuracy of up to like 90% or 80% because then you have spread also. Okay, so you need to like balance, you need to like choose the best risk to reward ratio. So you have the maximum, the market moved against, and you have the maximum, the market moved towards. So your own work now is to spend multiple hours looking at this data. As I forex trading is very similar to the data analysis because basically that's what we are doing. You spend hours looking at this data. Sometimes it don't take up to hours, but You just take your time to look at it, and just be thinking, okay, what stoppers can I use? What CP can I use? And if you get a particular thing which you want to use, and you have another one which you feel like maybe better, you don't know. Simulate is called simulate, yes, simulation. Simulate picking all the trades with the SL and TP profit targets to know that which is more profitable. Okay, so I'm going to give you an example of this. All right. Initially, when I started with this Euro CHF trade, I said I was going to use 5 pips stop loss. If I'm using 5 pips stop loss, my CP would be, when it hits 10 pips, I move myself to break even. Then CP will be 19 pips. So that means RR would be, that's actually what ratio will be 1 is to, I think about 1 is to 2.6. But then I was looking at this thing. Yes, with the because of the risk to reward ratio is 1 is to 2.6, the profit at the end of the month for some months is not actually that much. Let me open my backtesting book so I can read it from it. So if I'm using that model, that trading plan, for the month of, I'm coming now, 2.7 rather, 1, 2, 3, 4, 5, 6, 7. 7 times 2.7, that's 18.9. Then we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. That's 7.9. So if I'm using this particular plan, my profit in June would be 8.6% if I'm risking 1% per trade. Not bad. My profit in July will be 7.9% if I'm risking 1% per trade. So if I'm definitely I'm not going to risk 1% per trade. Who risk 1% per trade when you're not trading for firm? Um, so definitely I'm going to risk 5% per trade. So if I'm risking 5% per trade, my profit here will be 39.5%. And for this one, I think you've probably punched in the numbers and you've seen that the risk reward ratio is meant to be higher now. This and this and this thing. Spread is about 1.6 pips. So you're meant to add your spread to this 1.5 pips. Let's take it to like 6.5 pips. That'll be a total of 6.5 pips. So I'm like, okay, you have to. So let me tell you something here. When you are doing your back test, sometimes you're going to get a plan. This is working very, very well. But then at some point, you just like, what if I do this? What if I do this? All right. What if I do this? What if I do this? All right. Is that going to make me more profitable or less profitable? You try it out to see. So what I did is like, what if I reduce my stop loss? So I looked at most of these trades. Most of the trades, they don't. Yeah. I looked at these trades. Most of these trades don't. Coming on. Most of these trades don't. What do you call it? Don't move much against me. If you're using a stop loss as high as 5 pips, then most of the trades should actually be moving towards, giving you like some big movements against your intended direction. You get what I mean? All right, but most of these trades have this pinpoint reaction. Most of these trades have this pinpoint reaction. What do I mean by that? Let me show you an example of what I'm talking about. So if you look at this particular trade, which was a win, can you say this was a win? The maximum the market moved against me was how many pips? Entry point was at the open of this candle. So you can see this market didn't even move up to 1 pipet against me. It just started going up from here. So even if I had used a 2 pip stop loss on this particular trade, I would have won the trade. And if I had used a 2 pip stop loss on this particular trade, because they adding my spread to this thing, it takes this into like 6.5 pips. That's risk to reward ratio of like 19. Risk to reward ratio of about approximately 2.9 pips. Okay, 2.9. So, all right. If I had reduced my SL to, let's say, 2 pips, then you now add the 1.5 pips of spread, taking everything to 3.5. Risk to reward ratio increase from 2.9 to 5.4. That means if I'm risking 1% per trade, that would be an additional almost 2% profits. And if most of the trades actually look at this other trade again, notice that the maximum the market moved against me from the entry point, which was this candle, was 0.8 pips. So why am I using 5 pips stop loss? So I looked at all the trades to see the maximum, the average maximum, all of them moved against me. You notice that in June, all the trades actually hit CP. The maximum they moved against me was 3 pips before they made the move. And that 3 pips was just only one trade that moved 3 pips against me. The remaining ones moved by 2 pips, 1.5, 1.3, just moved from that particular entry point. Then I looked at July and I saw that, okay, some of the trades that hit CP moved 2.5, 2.4 pips against me, 2.9 pips against me, 2.3 pips against me. 2.1 pip against me. Then looking at what they call it, looking at August, some of the trades that actually moved in my direction moved like pinpoint from the entry point. They didn't even move against me. So I'm like, this 5 pips I'm using as a stop loss is just too much. Are you with me? Because if I use 2 pips, if I use 2 pips for this particular one, I would have won this trade. Even if I had even used 1 pip self as my stop loss, I would have won the trade. If I had used 1 pip, once you add my spread to it of 1.5, this take this into 2.5. My extra body should increase to 1:8. 1:8 risk to reward ratio. If I had used 1 pip stop loss. And a lot of these trades do not move up to 1 pip against me. But that 1 pip is not going to be too extreme. I'm just showing you how this thing actually works, okay? So if I had this 1 pip plus my stop loss, look at it, it's not a stop loss, and it moves to hit this thing. I want to add your spread to be 1:8 or thereabout. This particular one also, the maximum it moved against me was what? 0.6. So if I had used 1 pip stop loss, my stop loss would have been here. So that the market did not hit the stop loss, it just went from there. If I add my spread to this, it will take my distance to be, because spread is 1.5 pips, so this will be like 2.5. And if you keep checking most of the trades, you see that, so you don't get your stop loss and your TP based on what the Holy Spirit told you. You get it from what you see from your hindsight data, what you see from your backtesting results. So for this particular one, if I had used 1 pip stop loss, yeah, the market would have stopped me out. Because clearly you can see here that the market's moved up to 1.2 pips against me. And this trade would have been a win. So that means that 1 pip is too small. So what if I use 2.5 pips? If I use 2.5 pips and I add my spread of 1.5, you take everything to 4 pip as my stop loss. You take everything to 4 pip as my stop loss. All right. So you look at all the data and you tell yourself what is the best stop loss I'm to use based on all this data. So from what I saw, I don't know if it's the most profitable one, but from what I saw, if I use 3.5 pips as my stop loss and I took all those trades, let's assume I took all the trades in June and July. I took them on one account with 5 pips stop loss. This is how much I would have made if I used 1%, 8.6, and how much I would have made if I risked 5% in June and July. But then if I use 5 pips stop, if I use 3.5 pips stop loss instead, this is command C. This is the advanced cocoa. Get this cocoa and you would always be profitable in Forex. Or if you don't have something to use to trade, you will just wait. All right. When you wait, eventually you will see something. All right. So risk to reward ratio for this would be increased to 3.8. Yeah, definitely. Since I reduced my stop loss, some of the trades that are meant to be a win in this particular one will be stop loss here. Accuracy is going to reduce if you reduce your stop loss. The smaller your stop loss is, the lower your accuracy is going to be. Okay. Right. But that's why the risk to reward ratio is split. So if I did this, if I had done this, risking 1% would have given me 17.4% profit. That's almost double. That's double self of what I would have made risking this one. And then if you multiply it by 5, that'll be 87%. That'll be 7%. And for July, this would have given me 11.8. So I'm going to ask you guys now, what particular trading plan is more profitable? Whichever one you say is the one we are going to use to trade from September. So let me know in the chat box. Let me know in the chat. Chat, let me know. Let me know your answer. Chat, let me know your answer. Which one is more profitable? Which trading plan is more profitable? Trading plan A that give 43% profit with a 5% risk per trade. Or trading plan B that give it 7% profit with same 5% risk per trade. So drop in the comment section A or B. A or B, which one is more profitable? Who's the first person to actually answer? Coach Olivia, Coach Emmanuel was the first person to actually answer. That's powerful. So you see it's not guesswork. Now, this my trading plan may not be the best. It may not also be the most effective because as I'm looking at this trade now, I'm only catching 19 pips with my TP. A lot of the trades that I'm seeing in June give approximately 35 pips. So if I adjust my TP and I'm catching 35 pips. Let's assume I'm using a trailing stop loss by profit target points. Once you hit this point, I move my SL to this point, like that, like that, like that, like that, like that. With this same five, this thing, my risk reward ratio is going to increase from 1 is to 3.8 to 1 to 7. Maybe that one will be more profitable than what I actually have here. It may even give up like 200% profit. Who knows? I don't know. But that's going to be left for me to decide in future. And the only way I can actually decide is by looking at my trading plan, looking at every single thing and trying to like see the best way. You understand? It's more like optimizing the strategy, right? Optimizing the strategy to get the most profitable trading plan. Because the whole point of trading is to make money. Okay. And double is always better. Are you with me? So that is just basically how it is. Right. So you get a plan, you get a pattern that is constantly repeating itself. That's going to be the basis of your strategy. You backtest and get all the possible data you can get from that particular plan. Sorry, from that particular pattern that is repeating itself. Then you look at that data and use data to create the best trading plan. And even if you've gotten what you feel like maybe the best trading plan, still look at the market from time to time. Still check. Who knows? You can be able to like optimize it better. All right, see this your aesthetic stuff here. That's gone to the entry point already and is in profit already. The used to what you should aiming for with this thing is 1 is to 20. I told you. Right? This particular one, see the market did not give 1 is to 20. It gave 1 is to give me about 1 is to 8. Right? Because I'm using trailing stop loss. So when it hit this 24, this thing, 240 pips. I use 20 pips SL, by the way. When I reached 280 pips, the 240 pips, I moved my SL to 160. So from 280, 240, it came back to 260, took me out at this particular point, then kept on moving. That's not concerning me, right? If you look at this strategy, the accuracy, average accuracy should be around 20% or thereabouts. But I don't care. Right? The trading plan I'm using for it is the trading plan that will give the most profits for the strategy. The trading plan that will give that gives the most profits from the strategy. How did I get the trading plan? I backtested it. Okay. See if I can show you one example. I don't think this is the okay. Look at this one example here. So your trading plan is not something you get from divine inspiration. It's something you get from looking at the market and making informed decisions based on your backtesting results. Okay, so let me just show you this thing. So when I say, oh, I'm doing this one, I'm doing trailing stop loss by this one, I'm not just saying this because of that. I've spent multiple hours looking at the backtesting result I got from spending multiple hours backtesting the market. And from that thing, I came up with a plan. Is it the best? Maybe not. But from what I was able to get, it is the most effective I was able to get for that particular time being. And I've looked at it, compared it to different trading models, and seen that it's very, very profitable before I introduced it. I don't want to start going back and start wasting time because of time. So let me just use this one. Well, I have, I think what's second there. If you know you really want to take trading very, very serious, make sure you get a very big fat book, very big fat hardcover. Make that your backtesting journal. Now use that book to always do your backtesting. This is going to make it more fun. Because anytime you open that book and you see what you've done in the past, it just makes you see yourself as a very, very serious forex trader. The forex trading is a very, very big and sweet business. Tomorrow I'm going to teach some other parts of this thing that I was not able to cover on this session. 24th of July. I'm going to teach some part of the training I was not able to cover on this session. It is an example here. And that is okay for this particular this thing now, yeah. I say when the market hits this particular price, I move my SL to this price, I move my SL to this price. That how did I know that these are the best points to put my SLs at? Why did I choose 1,660 pips? Why not 100 pips? Why did I choose this particular pip? Why did I choose to move my stop loss at this particular interval, not this particular interval? This is actually an example of the trade on the extra, the first, second, third. When it got here, just started flying from here. Max TP is 400 pips. So see, this was, it got to 80 pips. It didn't come back to hit break even. Got to 160 pips. It didn't come back to 80 pips. Got to 240 pips. It didn't come back to 160 this thing. Then it just kept climbing up from there. It is that one that actually hits and did that. Okay, I get. That's 28. So that's just basically it about that. All right. So at this junction, I'm going to end our live session. And if you know you got value from what I thought today, because I've been speaking and talking and teaching and lecturing for the past 45 minutes, if I'm not mistaken. If you know you got value from this session, help me head over to the group chat, our WhatsApp group chat, and drop value there. So those who are not on this session can know that they have missed out on a lot and they can feel very, very bad. Look at the the aesthetic trade. See, this was the entry point here. See, seems to have already hit TP1. Okay, it's not hit TP1. But it's already 1 is to 2 risk to reward ratio. Because stop loss is 20 pips and TP1 is 40 pips. So TP1 is 80 pips rather. So see, as the market just got to the entry point, it's climbing up. So this one can just keep climbing till it goes to give us the 1 is to 20 risk to reward ratio. Who knows? I've never got to 1 is to 20 risk to reward ratio this month yet. I've got 1 is to 8, I've got 1 is to 12, but not 1 is to 20 yet. So you see, the stop loss was adequate enough to not get hit by the trade, and then it's flying. That is basically it for this session. Thank you very much for joining. See you guys in the next live session. Have a lovely, fantastic, beautiful, and amazing day. Bye. And please don't forget to drop your value on the group chat if you got value. Yeah. Thank you.